Yes, good afternoon or good morning or good evening for those of you who are coming, attending at various times a day. Welcome to the fourth Profitability Analytics Center of Excellence webinar. It's titled Measuring and Managing Customer Profitability, and it'll be presented by Gary Cokins. My name is Larry White, and I'll be introducing the webinar. First of all, there's a little bit of a problem with some of your names. A lot of you came in under the name Rafe Lawson because Rafe, as one of the supporters of PACE and an IMA staff member, sent out this email to a lot of people. So we apologize for that little snag. So don't be surprised. Your questions are equally valid. Go ahead and shift, Gary. Gary welcomes your comments and questions. This contact information for him is presented here. It will also be shown again at the end of the presentation. So if during the presentation you feel the need to contact him, he'd love to speak with you. Advance, Gary. The profitability analytic model's goal is to provide a guide to get finance and accounting more engaged with business planning and decisions. We want to make the idea of being a business partner actionable and realizable. To do that, we leverage the strategic planning process with a focus on three tiers: revenue, cost and operations, and investment. Shift, Gary. The profitability analytics model leverages, of course, the power of the strategic planning process in an organization and traditional elements of ROI, return on an investment, but not in a traditional manner. For instance, we think of investment in intangible resources as equally important as investment in tangible resources. Shift. The profitability analytics model focuses on internal decision support and causal relationships, not financial reporting standards. The profitability analytics model is about principles for good internal decision support, not methodologies. Today, Gary will discuss ABC as a method used to generate the necessary level of causality for customer profitability. The profitability analytics model is about real economic impact, the reality of resources, customers, processes, markets, and investments. Advance, please. The PACE group has worked with IMA to create 4 SMAs that support profitability analytics concepts, and those are all available on the IMA website. Doug Hicks wrote a novel slant case study that applies profitability analytics and demonstrates business partnering called Profitable Expectations, a great little story with a lot of lessons about profitability analytics. Advance, please. So now let's shift our focus to introducing Gary and today's topic. Gary is a very well-known author and speaker, a member of the PACE board, an expert in activity-based costing, performance measurement, business analytics, which he has applied as both a practitioner and a consultant. Gary, I'm turning it over to you.
Well, thanks, Larry. And it's a privilege to be working with Larry White, Doug Hicks, Rafe Lawson as the advisors to PACE, which we created about 2 years ago, but it's really picking up steam. You know, just briefly on my background, you could say I got an industrial engineering degree from Cornell in 1971, my MBA at Northwestern Kellogg. If you're doing the math, I am 71, but I feel like I'm 41. My career was in 3 segments. First decade, FMC Corporation, Link Belt. I was a division controller. Middle 15 years, consultant with Deloitte, KPMG, and EDS, now part of HP. And then up till 8 years ago, I was with 16 years with SAS. I think careers have a lot to do with luck and circumstances than being smart and competent. And in 1988, KPMG struck an exclusive contract with Harvard Business School professor Robert S. Kaplan to train people on activity-based costing. Many of you recognize his name from the Strategy Map Balanced Scorecard, but he did the early pioneering work. So for 5 years, I implemented activity-based costing, wrote a book, and that led to more books, and that's the explanation for the books. Okay, who will benefit from this presentation? Managers who have previously struggled at promoting the measurement and reporting product, channel, customer profitability into their decision support systems. Managers who intend to champion profitability analysis techniques and need a compelling call to action. And the reason I've championed in quotation marks is because it's been my observation that although it's nice to have senior executives sponsor new ideas, progressive methods, innovation, often they are preoccupied with firefighting and short-term priorities. It's typically managers 1, 2, 3 levels down in the org chart who kind of have passion, fire in the belly, ask themselves, how long do we want our organization to perpetuate using continuing stale and arcane methods? They're the ones that'll do a pilot proof of concept to demonstrate to their colleagues, this is the way to go. So if you're down in the org chart, that's fine. I like what I'm presenting to you. Put on your seatbelts. I'm going to go fast. There's about 60 slides, but the presentation will be available to you later. I'd like to start with this cartoon, drowning in data, but starving for information. You've got this poor beleaguered clerk, shoulders hunched, sad, paper all around him. Supervisor in the doorway to the left says, looks like you got all the data. What's the holdup? I gave you the request this morning. How come you don't have the answer this afternoon? And the message here, there's a big difference between data and information. You convert data, transactional data, into information. I like to start all my presentations with these 3 questions. What, so what, then what? So imagine that you actually do implement the methods we're going to describe in this webinar about how to calculate customer profitability. You're not done. One day, it's going to open up a lot of new insights and questions, which leads to the next question. So what? What's relevant? Later on, I'm going to talk about an important question, then what? Because when you make decisions, they only impact the future. So my agenda is I'm first going to have to start off with some of the basics on activity-based costing. It's kind of a primer. It's sort of foundational in order to calculate the channel and customer profitability, the 3rd bullet. I am going to, between that though, share a method that you can actually implement ABC in 2 to 3 weeks, not 6 months to a year, which will surprise some of you. But I do want to briefly talk about the difference between the historical view, through the rear view mirror last month, last quarter, and the predictive view, planning, budgeting. And then something that really is a concern of me and actually all of the advisors on PACE. Why is it taking so long for organizations to adopt these methods? So let's start with the basics. This is a primer on activity-based costing. To understand how to measure customer profitability, we need a brief primer about ABC. And, one of the books that I authored after being trained by Professor Kaplan was on ABC. So let's put some context here. Ideally, what you want to do, though, is to have direct costing. What I'm showing you here is a spectrum from left to right. The highest form of direct costing is project accounting, but it only really applies when there is like a make to order or one of a kind building a satellite. Many organizations use standard costing the next level over. And I want to point out now, this will all apply to service organizations as well. In fact, in the United States, only 8 out of 100 jobs make products. The other 92 are services. ABC to the 3rd left is what I kind of call the poor person standard costing system. It isn't quite as elaborate to all of the standard costing, but the real message on this slide is allocations are bad. We'll talk about allocations. It's a sort of a dirty word. So let's talk about what is ABC. A simplest way to describe it is imagine you go to a restaurant with 3 other friends. You order a little salad and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, That's how products and standard service lines also feel when the accountants take this large amount of indirect expense, commonly called overhead, and they allocate it like spreading butter across bread using allocation factors like number of labor hours, number of units produced, sales dollars, headcount, full-time equivalents, sales. None of those factors reflect the unique consumption that the products and standard service lines consume of the end-to-end business processes and the work activities that belong to those processes that consume the expenses. So if you were basically to decompose all of those indirect into maybe cost pools, I'll talk accounting ease here, and trace and assign them based on a cause and effect relationships, you'll discover, compared to the standard costing butter spreading, some of those products and services, in fact, are overcosted and the others must be undercosted because it's a zero-sum error game. So yes, okay, it satisfies the external statutory reporting, for the auditors, but it's wrong in the parts. So the simple explanation of ABC is as if the waiter or waitress brings 4 individual checks. You only pay for what you consumed. Now, the reason that's led to ABC over the last 30, maybe 30, 40, 50 years has to do with this diagram. It shows the 3 universal components of any organization's expense and cost structure. The recurring labor at the bottom. Notice I don't just use direct because service organizations may think, oh, it's manufacturing. No, this is universal. Direct material and the indirect expense. And when you ask people, why is the indirect displacing the direct? They'll say, well, automation, robots, that kind of stuff. We're kind of automating out the frontline workers. That is secondary. The main explanation for this is over the many years, all organizations have had a proliferation of different types of products, different types of services, manufacturers, more colors, more sizes, more ranges. Banks have more types of depository accounts. The point is this: whenever you increase the diversity and variation of the outputs, it just produces complexity. Complexity requires more and more indirect expense to manage it. So 50 years ago, when the indirect was relatively thin and the direct cost was the accuracy, you didn't need ABC. But today it's different. The indirect is much substantial. We can't do the butter spreading. Now, the problem actually begins with this traditional responsibility cost center statement. Every manager on the planet Earth recognizes this. But when you ask managers who received this report, how much insight and understanding do you get about the cost that you can influence and control? They say, not much. I like to say when managers get this kind of report, they are either happy or sad, but they're rarely any smarter. It's not that the report is a bad report, it's a good report. It's just that the data in this format is not structured in a way that can answer the question. So what activity-based costing does is it changes the structure. It changes that same $914,000 salary equipment into the middle, the language of work, key scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. And then it reassigns all of those activity costs into the products, services, channels, and customers, just like the waiter or waitress in the restaurant, based on a cause and effect driver. Many organizations think that the expenses start on the left. It's actually the opposite. Your expenses actually start at the right side of this diagram. The products and services and customers place demands on the workload in the middle, and the workload draws on the expenses to the left. So demands on work flow right to left, then the costs go left to right. It's a principle. Rules are many, principles are few, just like speed of light or gravity. You can't alter a principle, but the accountants violate it when they do that butter spreading. Now, it isn't quite as simple as I just described. I've rotated the previous slide 90 degrees. It isn't just, we just take our ledger expenses, put them in activity cost pools, and somehow assign them to objects. It's more complex. The right side is more realistic because you have support activities that support other support activities that ultimately support the frontline activities that interact with customers or make products. So it must be a multi-stage cost assignment network. Now, I want to warn you, the next slide is going to be complex. I'll go through it quickly, but you can go to the IMA website, imanet.org, search on my name or a SMA called Implementing ABC, 30 pages. It'll take you through it. But real quickly, the diagram has the three universal components of any organization's expense and cost structure. You've got the expenses at the top. All of the costs are calculated. That's the work activities in the middle. And they eventually pile up in the bottom into the product, services, customers, something we call business sustaining. Now you need to adjust your thinking. This is not a process flow chart with swim lanes across. It's a reassignment network. So if the organization spent $2 million in January, it will be the exact same $2 million of work activities, and that will pile up into the bottom two right boxes, ultimately into the customers, and something we call business sustaining exactly to the same dollar or euro. Business sustaining is a special category. There will be some expenses that have nothing to do with making products or delivering services to customers, things like the legal department. So we create a business sustaining cost object like senior management, and we trace it to there. We still have to recover those expenses. They're typically 10 to 15% of an organization's monthly expenses, but they're not traceable. If we trace them to the products or services, we'd be overcosting them. All of the arrows you see, the vertical arrows, think of them as thin pipes or wide, thin straws or wide pipes, where the diameter reflects the amount of money going through. We also have people activities and equipment activities. Men and women run machines, machines make products. Men and women drive buses, buses deliver passengers. So assets also do activities. Now, in the context of this webinar, I'm going to get to the customer profitability. Look at the two boxes that are going straight to the customers. They're not going to the products. That's because these are examples of activities like selling, marketing, channel distribution. Direct cost, not broken. You may have data integrity issues with that. That's a different problem. So the net consequence, though, is when you do activity-based costing, use that assignment network, you discover that some of the products are overcosted and some are undercosted, as I mentioned. So the horizontal line is the bad way, the butter spreading. The vertical axis is the magnitude of the error, percent error. So to the left, that's going to be like you in the restaurant ordering the salad. Typically, it's the simple products and services that are subsidizing those complex products and services to the right. And that's the three other people in the restaurant, that ordered the expensive item on the menu. This is what's more important. What does one see after you've calculated ABC? And you're looking at real data here from a real company. The vertical axis is the net revenues minus the properly calculated and traced ABC cost. The horizontal axis is the cumulative buildup of profit, rank ordered from the most profitable product to the second most profitable product, and so forth. The last data point of this roughly 850 products will always reconcile exactly with the P&L. It's always organizational shock whenever a company sees this, what's referred to often as the whale curve, because it looks like a humpback whale. In this particular case, this organization had roughly $8 million of unrealized profit on 3/4 of their most profitable products. They lost $6 million on the remainder to net out at $2 million. They can never believe it because their belief system is this blue line, that says, oh, we make money on almost everything and lose a little bit at the end. No, that's because all of that butter spreading allocations was crushing and suppressing that blue line down. When ABC was detecting all the diversity and variation, reflecting the upper line. So the upper line is the truth, the blue line is false. Some of you may be asking, well, what do you do with all those unprofitable products to the right? Do you drop and abandon them? No, that's because some companies deliberately have, if you will, lost leaders that are unprofitable, but they're associated with winners to the left. Also, accounting does a terrible job with life cycle costing. It's always period costing, January, February, March. So if we have a new product that's been released, it's in a shakeout period, extra work, not enough volume, it's going to appear to the right side as unprofitable. But as we refresh the model every quarter or monthly, it will migrate to the left and be profitable. The point is this: you need fact-based information. And in the absence of facts, anybody's opinion is a good one. I'll repeat that. In the absence of facts, anybody's opinion is a good one. But unfortunately, usually the biggest opinion wins, which is the opinion of your boss or the boss of the boss. So to the degree those executives at the top are making decisions on gut feel or intuition or flawed and misleading information like the blue line, the organization's at risk. Here's another example real quickly. This company is losing $500,000, but they really made almost $5 million of unrealized profit. On $4.5 million, they lost the remainder. These whale curves always show up. And there's more here that meets the eye. If you were to just look at one of the unprofitable data points in the whale curve, what's really happening is each product is reaching up into the work activities and asking, how much of each of you did I uniquely consume last period? And it piles them up like pancakes, where the thickness of the pancake is a result of the equation, the quantity of the driver times the unit level cost consumption rate. And that gives us the transparency that's always hidden with the traditional standard costing. I love this cartoon. You've got this signboard, answers. To the left, simple but wrong. But to the right, a little complex, but right or correct. Look how many are going to the left. And I have empirical evidence that almost 95% of organizations where activity-based costing is applicable are still spreading the butter. Very few are taking the right. And part of that is because I think ABC is too complex, too difficult to implement. I'm going to show you a fast way in a second. But I also want to point out to the left, notice they're falling off the cliff, going bankrupt. It's dangerous to provide managers with bad information. I do want to basically dispel some myths about why ABC is not that difficult to implement. Many believe that activity-based costing can be complex and that an organization needs to determine if the benefits are worth the effort. Many have this perception, but it is a misconception. I next describe why this is a fallacy and how this problem can be resolved by right-sizing the ABC system to be good enough. One reason that many perceive ABC to be excessively complex is because in the 1990s, accountants and consultants way over-designed the ABC systems well beyond the point of diminishing returns on higher cost accuracy for the extra levels to collect, calculate, validate, and report the cost information. The ABC models were not understandable and so large that they collapsed under their own weight and were unsustainable. Sometimes executives pulled the plug before completing and viewing it as a meaningless exercise by the bean counters. Activity-based ABC rapid prototyping with iterative remodeling resolves this problem. It can be implemented in a few weeks. Let me quickly describe rapid prototyping. You basically just start with a 2-day workshop with 5 or 6 cross-functional managers in the room. You build an ABC model very quickly, high level, not intended to produce any results that are accurate, okay? Afternoon of the second day, you bring in the line manager and executives. They see it's very engaging because it's their own company. The light bulbs go on with everybody. Oh, that's how we could really get accurate profit margins and validate our pricing. Oh, that's how we control, understand what really drives our cost. Oh, that's how we could do benchmarking with apples, not apples and Oreo. Oh, they get it. You then take a week, do a little more decomposition, model 1, a little more, within 2 to 3 weeks, bingo, permanent repeatable production system. You don't need timesheets. The models that were all so large are really too complex. Typically 50, 60, 70 activities is sufficient. Make your mistakes early and often, not later when the system is too hard to change. And the reason rapid prototyping works has to do with this diagram. The vertical axis is the accuracy of what you want to know. Let's just say you just wanted to know your product or service lines costs. The horizontal axis is that level of administrative effort to collect the data, validate the data, calculate it, report the data. You will always get an asymptotic curve. And I want you to look at that dark line I just popped in. Notice how the slope goes up real quickly, hits the elbow, and to the right, diminishing returns on extra accuracy for the extra level of effort of work. Stop at the 95%, good enough. It doesn't have to be perfect. This is not external statutory reporting. You know, if you get those numbers wrong, you go to jail. But if you get the management accounting numbers wrong, you don't go to jail, you know, so ease up. Now, what's a mystery to most accountants is what do you think determines, most highly determines the vertical slope of that black line? It's not timesheets. It's the multi-stage cost assignment network. It's the piping of all those relationships. That's what actually produces the accuracy. Benefits from rapid prototyping, accelerated learning. Everybody kind of gets it. Misconceptions go away. Solves that thorny leveling problem. Is there going to have 2,000 activities or 1,000 activities? No, it right sizes itself. It prevents that over engineering of the size and complexity model. That was why people think, oh, ABC's dead. It doesn't work. No, ABC's just full absorption costing done correctly. And also at the end of that second day, you ask the managers, when you get this permanent repeatable production system in a few weeks, what will you use it for? Oh, I can validate pricing. Oh, I could do this. I could do that. We start getting the commitment that they're going to use the information. We don't want to get a baseball field of dreams. If we build it, then they'll come. So now the presentation you've all been waiting for about channel and customer profitability. The shift from being product-centric to customer-centric. The emphasis will be much more on economics, measuring customer profitability, in some cases, customer lifetime value. The value of a company is really a function of the value of its customers. The only value a company will ever create is the value that comes from its customers, the current customers and the new ones acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we've got a couple of problems here. Most CFOs are not measuring customer profitability. They're stopping halfway at the product gross profit margin line. They've got to continue the journey. So what about all these other calculated costs? Products and standard service lines are not the only thing for which accountants should compute costs for. What about all the costs that have nothing to do with making products and delivering standard service lines? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture. I'm going to make a case that the bottom half, below the product gross profit margin line, is more important than the top half. Visually, to basically look at this fictitious income statement, they got sales of $100, direct cost and indirect overhead 70. It'd be nice if they basically trace that overhead using ABC. But what about when we bring in selling, distribution, marketing, admin? That's not visible. A way to view this, imagine that the entire expenses last month, last quarter, is the entire rectangle. The accountants are only calculating the product-related costs, material, labor, and indirect. What about when we bring in and expand to the channel, distribution, selling, and marketing, and all the rest? The white space is more important than the dark space. And here's why. I'm going to give you 4 reasons. I call this the perfect storm. First reason, customer retention. It is relatively much more expensive to acquire a new customer than to retain an existing one. That's a no-brainer. Why? Because existing customers are a sunk cost. You already have them. And if we understand decision theory, for future decisions, we only look at the relevant cost, the relative, variable cost. Second, sources of competitive advantage. As products and standard service lines become commodity-like, then the shift is towards service differentiation. I already mentioned customers are the source of value creation for shareholders. But as all competitors have similar kinds of products, banks, all the same kind of depository accounts, insurance companies and the like, we have to basically look at the differentiated services. Next, customer relationships, one-to-one marketing. In the marketing world, Don Pepper and Martha Rogers, they're gurus in marketing, have hailed technology as the enabler to, 1, identify customer segments, and then tailor the marketing offers, deals, coupons to make them buy more. And then finally, the power shift. The internet is shifting power irreversibly from sellers to buyers. And I just don't mean you at your household buying stuff on the internet. Today, purchasing agents in a company with a click of a mouse can see 10 to 15 suppliers and all the information about them. This is a one-time event happening in our lifetime. So if you understand these 4 forces, put them into context, it's why it's important to measure customer profitability. But now we've got this problem, angel customers and demon customers. All organizations will have high maintenance customers and low maintenance customers. Examples of high maintenance customers: always shifting schedule, never buying standard, always special, always calling help desk, always returning goods. Low maintenance customers, the angels, we love them. Only buy standard, never shift schedule, never call help desk, never return goods. If those two types of customers bought the same volume, same mix, the same price, they're not equally profitable, because the high maintenance customers, the demons, erode your profits by causing you much more work. But what caught my interest with this book is not the main title, but the subtitle: Discover Which Type of Customer is Which and Turbocharge Your Stock Price. And that's the basic, that message about we need to connect customer value creation to shareholder and owner creation. Incidentally, this book is written by marketing faculty at Columbia. There's not much about cost accounting in it, so I wouldn't get it to understand that. So here is a decomposition of the multi-stage cost assignment network. I'm not going to go through it in the interest of time. Again, it's in the 30-page statement of management accounting you can get from the IMA website. But when you go from left to right and bring in each of the activity drivers, effectively what's happening is we're eroding the profit level by level by level, and that allows us to get this nirvana, an income statement, profit and loss statement for each customer. And for this fictitious customer, you'll notice to the right on the margins, it had a 30% composite average gross profit margin, because the customer is buying many different products above 30%, below 30%, but the composite average is 30. But between the 30 and the 8 at the bottom, 22 more points of profit margin are lost, nothing to do with making products or delivering the standard services, all below the line. If we calculate that for every customer, we can put each customer as a circle, as an intersection in this matrix, in this grid. Now, the vertical axis is the product mix gross profit margin, remember, above the line. And the horizontal axis is that cost to serve, selling, marketing, distribution, customer service, from the angels on the left to the devils on the right. And now things become obvious. The most unprofitable customers are going to be in the bottom right, because they're buying low margin profit mix from you and they're difficult to serve. The most profitable ones are in the upper left, because they're buying high margin mix from you and they're easy to serve. And now the name of the game is moving the dots from the bottom right to the upper left. And that's where we got to get the marketing and sales people to get involved. Incidentally, this is very embryonic. For the few companies that are doing at customer profitability, even fewer are doing this. They're changing the commission structure, the sales incentive for the sales force, to not be 100% exclusively sales volume, but a blend, like 40% profit for each customer, 60% sales. And when the sales director has what are called account planning meetings with each of their sales force, they basically set these targets. And now what we're doing is we're basically motivating the salespeople to somehow alter the behavior of their customers in harmony with the expense structure. I'll give you a few examples in a second. Another way to look at the same data points, now I've replaced the circles with squares. The horizontal axis is the sales volume of a customer. The vertical axis is the profit, profitable above and unprofitable below. Notice the square to the farthest right. That's our highest sales customer. But above that is a few customers, less sales. But below it are a whole bunch of customers, pretty high sales, they're unprofitable. What's the message? The message is sales volume is not a proxy for profitability. So to start understanding this, what's really needed is the CFO must now basically start helping sales and marketing to better target customers. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits for the shareholders and owners. This means answering questions like, which type of customer is more attractive to newly acquire, to retain, to grow, or win back, and which types of customers are not attractive? And then for the customers that are attractive, how much should we optimally spend attracting, retaining, growing, or recovering each customer microsegment? And the reason I have optimally in italics is it is an optimization problem. Why is it an optimization problem? Let's return to our book. Remember the subtitle? Discover which type of customer is which and turbocharge your stock price. Well, there are two ways you can destroy shareholder wealth. You can destroy it first by overspending unnecessarily on loyal customers for what's needed to retain them. You know, you wined and dined them, but they're still going to buy the same volume and mix regardless. But you can also destroy shareholder wealth by underspending on marginally loyal customers who are sitting on the fence and risk their defection to a competitor. So for each micro segment, and I deliberately use the micro segment, what is the optimum spending level for differentiated services, coupons, deals, offers, price discounts for micro segments? And the reason I use micro segments is because the marketing world doesn't just look at, oh, old, young, male, female, you know, they actually do a lot of segmenting. Each one of those is an optimization problem. Now, what are some of the actions to basically move the customers from the bottom right of the grid to the upper left? One, manage each customer's cost to serve to a lower level. Just be more efficient. Improve and streamline customer-facing processes, including adding self-service models where possible. You notice the hotels now have kiosks where you come in, you basically put your credit card in there, it gives you your key, you go to the room. You don't need desk people. Establish a surcharge or reprice those expensive costs to serve. Remember our high maintenance customers, we're jumping through hoops for them. Well, let's start putting a price on that. You know, the bank started to do that on depository accounts. The airlines have been doing that with baggage or charging you an extra fee to get to an aisle seat. Reduce the services, focus just on the labor intensive ones. Introduce new products and service lines. Abandon old products or service lines. You could raise prices, you may not get much action there. Improve and streamline the internal business processes. Offer the customer profit positive service level options with varying prices, you know, just like FedEx and DHL. You know, if you want 1-day delivery, you pay a certain price. If less than that, you know, we call that upselling, and next upselling or cross-selling the customer's purchase mix towards the richer, higher margin products. You know, if they buy a set of golf clubs, can I sell them a golf shirt? They buy the golf shirt, can I sell them a second shirt, you know, at a discount, and discount the prices. There's many, many actions one can take. I like to use these quotes about ABC. It is better to be approximately correct than precisely inaccurate. In other words, it's better to be roughly right than exactly wrong. So many accountants are so hung up on detailed precision. Those in manufacturing, oh, burden rates, you know, we're concerned about 5 digits to the right of the decimal point. Your problem's 2 digits on the left. And in the land of the blind, the one-eyed man is king. So summary about the traditional flawed methods. When CFOs allocate, and notice I put it in quotations, that dirty word, indirect expense, in other words, overhead, the products and standard service lines, they spread it like butter across bread. CFOs violate accounting's universal causality principle. And returning to PACE, and I hope all of you are basically able to visit the PACE websites and our LinkedIn. You're going to find causality messages, articles all over the place. Activity-based costing resolves this by, quote, tracing and assigning expenses based on cause and effect relationships for how products consume work activities, which in turn consume the expenses. I briefly do want to talk about the future view. So I'm going to stray a little bit from customer profitability. Remember the then what question, you know, the future decisions? Well, when you're doing price quoting, you want to basically, for customers, you want to know, hey, if we do this, are we still going to make money? Now, here is a diagram, a taxonomy I created for the International Federation of Accountants. It's called IFAC. I want to go through it very quickly. You know, it's like taxonomies are like, just like in biology, plant kingdoms and you know, animal kingdoms. We've got 3 kingdoms in the big world of accounting. We've got tax accounting, financial accounting, managerial accounting, okay? To the left, after we calculate the cost, remember all costs are calculated. Expenses are when you exchange money with third parties, you know, currency exits the treasury, all costs are calculated. Process cost, product cost. When we go to the left for financial accounting, external financial accounting, we follow rules, generally accepted accounting principles, GAAP, Things like, inventory cost valuation. Yeah, you can spread the butter. The auditors don't care. It reconciles to the penny. But when we do management accounting, we start with the historical view, cost reporting and analysis. But then when we go to the future view, the predictive view, now we're talking about things like driver-based budgeting, driver-based rolling financial core forecast, what if analysis scenarios, rationalization. If we drop a product, we drop a customer. Notice at the bottom, I have this value spectrum. Low value to the left, we move to the middle, modest value, high value to the right. The value of accounting information increases from left to right. A lot of CPAs, I present webinars, they don't particularly like me or this diagram because what they're doing is closing the books for external reporting. And I'm really telling them, you're doing the lowest value. The real value comes when you move to the right. It does get a little more complex though. The historical view is really tracing. But when we go to the predictive view, we need to classify the behavior of the resources as sunk, fixed, step fixed, or variable. And that classification depends on the planning horizon and the type of decision. What I mean by the planning horizon is in the short term, capacity is not easily adjustable. But as you move out days, weeks, months, years, you could replace full-time employees with temporary ones. You could lease assets that you normally would have purchased. Okay, so it starts becoming variable. You have to think like an engineer. It's like microeconomics. Very important. And you start looking at marginal and incremental expense analysis when you do the predictive view. Now, briefly, the same organization, IFAC, I was able to write a paper for them, and you can see the IFAC logo at bottom left of the paper. It's called Evaluating the Costing Journey, Costing Levels of Continuum Maturity Model. Incidentally, you will find the access to this paper in the PACE website. And you could go to my website, garycokins.com, bottom left, it's in there. What I was able to do when they asked me, can you create a stages of maturity model? I said, sure. And here it is. I'm not going to go through it in detail. I said, basically, there are 8 stages of maturity in the historical view, descriptive costing, last month, last quarter. And then there are 5 stages when you go to the predictive view. You'll notice I've shaded 5D. Why? I have empirical evidence that 95% of organizations are at a 5D or lower. 5D is the old butter spreading, take the overhead, big fat cost pool and spread it like butter, okay? 6D is where we basically now start at least with activity-based costing to decompose the indirect overhead expense cost pools, trace and assign them on the causality principle. 7D is after you've done the product cost and service line costing accurately. Now we move to customer profitability. 7D is what I presented in this webinar. And if you're interested in unused capacity, I don't really think it's worth it. Personal opinion. I think most managers can by sight see unused capacity when employees start taking longer lunch breaks, and you've got a standard costing, you start seeing unfavorable cost variances for efficiencies. On the right side, 1P, basically, how do people do the predictive view? Each manager is given a spreadsheet, left to right, January to December, every line item to paper clips and rubber bands. They fill it out. Someone in the accounting department consolidates it, gives it to the executives with the revenues. They don't like that number. I call this spreadsheet budgeting. Go change some of the numbers. The managers change some of the spreadsheets, a little lower expenses, back to the executives. That's better, not good enough. Up, down, up, down, up, down, up, down. Geez, you almost wish the executives would say, what number did you want in the first place? But that would be their aspiration. What we want is reality. So what 2P, 3P, 4P is really moving to what we would just call calculating the ABC model backwards, using those calibrated unit level consumption rates times the forecasted volume and mix to solve for the capacity, number and type of employees, their salary and wages and spending. So to start summarizing, what's really happening here is there is a shift in the source of return on investment from tangible assets to intangible assets. So what I mean by that is the shift from ROI from buying machines and trucks and computer and hardware and software to an intangible asset like information. And you will see from this diagram as we go from left to right on the x-axis, we're going from data to information to knowledge to insights to decisions. The problem is many organizations, if not most, are stuck in the first two red bubbles to the bottom left. All they've got is raw data and standard reports. All they can answer is what happened. We really want this exponential curve going up to the right. Now, in some cases, the chief information officer, the IT director, has given some of the managers, maybe some employees, some of the what are called OLAP tools, query and drill down, to see a line item of an invoice or a purchase order. Popular software tools that do this are Click, Tableau, Microsoft Power BI, SAS, my previous employer. But managers are still restricted to only answering what happened. Enterprise and corporate performance management, of which management accounting is a subset, starts at the first blue bubble. It's modeling. When I showed you that multi-stage cost assignment network, the piping, that wasn't T accounts and journal entries. That was modeling. We were modeling how the expenses get consumed with a cause and effect relationship through the work activities, eventually piling up into the products, services, channels, and customers in the business sustaining. It gives you the visibility that is really needed by managers. Now, when we go to the predictive modeling, now the future's coming at us. Forecasts of sales, volume, mix. That's when we can start basically doing driver-based budgeting, driver-based rolling financial forecasts, not that spreadsheet stuff, up, down, but a much more progressive way. And then when we finally get to the top, prescriptive analytics, I refer to this as Mount Everest, the highest you could go. In contrast to the first three red bubbles, answering only what happened, to the descriptive model, why did it happen? Because we've got cause and effect relationship. To the predictive model, what can happen? What are our options? What are our scenarios? Sensitivity analysis. To the very top, what is the best choice of what can happen? And that's really the aspiration that data scientists, big data, operations research, all of that stuff could involve things like linear programming. So to summarize, I want to give the big picture of what enterprise and corporate performance management really looks like, and then we're measuring customer profitability, measuring and managing customer profitability fits in. I have many diagrams of enterprise and corporate performance management, and they're synonymous on my computer from Accenture and some of the IT vendors, but they're all IT diagrams with databases. This is my diagram. I'll explain it in a second, but notice where we want to go. We want to go from the box of customer satisfaction and loyalty all the way to shareholders and owners. Remember, we want to connect customers to shareholders. But just to recap, remember, the CFOs are only going halfway. It's like building the Golden Gate Bridge in San Francisco. Halfway, you got to complete it to get to the other side. Now, how does the diagram work? Well, first, where does management accounting and analytics fit in? I didn't put it in the diagram because the output of managerial accounting and analytics is the input to so many places. It's ubiquitous. It's everywhere. All right, let's talk about the diagram. First, strategy and mission, which will be a different webinar on PACE using, strategy map, balanced scorecard, Kaplan and Norton, that stuff is typically formulated by the executives based on the needs of customers. Oh, yes, you could do the Michael Porter 5 forces and all that stuff, but let's keep it simple. Once the executives have formulated strategy, they will communicate it to the managers in a way that they can understand it, typically with the strategy map, and they'll identify projects and initiatives and the key performance indicators and put targets on the key performance indicators to bring about accountability for the managers. Once you've basically got the KPIs and you update them daily or weekly, and every manager looks at their dials, they can answer the question, hey, how am I doing on what's important? When every manager can do that, how are we doing on what's important? those three arrows to the left, that's about strategy management, strategy execution. Now, where did this webinar fit in? It was the targeting. The big box is your organization. It's the assets and your employees, okay? Well, remember those questions. What type of customer are more attractive to retain, to grow, to win back and acquire? Which types are not? How much we optimally spend? This is where the accountants do need to help sales and marketing. The CFO typically spends, I think, too much time on operations, pounding on them. Oh, get your costs down. That's basically cost management. You can't basically drive costs down into perpetuity. Let's get the top line up and the profit margins up with basically what we described in this webinar. We then also, they'll get into some of the operational stuff, lean management, Six Sigma. The most universal end-to-end business process is order fulfillment. Take the order, complete the order, admit the hospital patient, heal the patient. So we want to connect all these dots. And speaking of dots, here are the dots. What you're looking at is happening every minute, hour, day, week, month, year. All of these things are flowing. The real definition of enterprise and corporate performance management is all of these various methods: strategy map, cost accounting, profitability, budgeting, risk management, moving dials, moving gears. We fit them all together. But to the degree, imagine some of these veins are restricted. They're tight. The money is not going to flow to shareholders. It's going to leak to the sewer. So you got inefficient processes or poor targeting of customers. We're not targeting the most profitable, the most attractive customers. So you may want to think of these flowing dials. This is the aspiration, the vision. You want your organization, or if you're a consultant or CPA firm, for your clients to basically get the full vision of enterprise and corporate performance management. Now, a big frustration that Larry White, Doug Hicks, Rafe, I have, why is the adoption rate for profitability reporting with ABC and all the other methods, quite frankly, been so slow? Well, here are three barriers. The first barrier are technical barriers. They're IT-related issues, things like dirty data, low quality data, but the IT world has a tool, actually a method called extraction, transform, and load, ETL. It's a mechanical way to basically kind of cleanse and purify the data. The second barrier is this perception barriers of excess complexity and affordability. I'm going to presume that many of you, when you basically logged in, said, this guy's going to talk about ABC. I know we can't do it here because it's too huge, too complex, 3,000 activities, all those misconceptions. I demonstrated to you, you can have a permanent repeatable production system 3 to 4 weeks. The real big barriers got nothing to do with systems, software methods. It's all about people's behavior, such as resistance to change, culture, and leadership. Resistance to change, do not underestimate how big it is. People love the status quo. They don't like change. Only babies like change with diapers. But other problems, fear of knowing the truth or other departments knowing the truth. When you do ABC, a product line manager who in the past had the most profitable product, after the ABC is done, they may not have the most profitable product. They're not going to want anybody else to know that. They're going to get in the way. Other issues, fear of being measured, fear of being held accountable. They're just worried about that. And weak leadership. There, I said it. I put it on the table. Not every executive team's got all the marbles in their head. So action steps, get educated. Thank you. You're attending this webinar, and I hope you attend more of the webinars and go to the PACE website and our LinkedIn, because there's a ton of education there. Get buy-in from the line managers and executives. Rapid prototyping. Start small. Think big. Improve incentives. I'm not an expert. I don't have specialty in motivation theory. I just know it's important. When you receive the slides here, there is a link in the resources to an article I wrote in February, but it's as applicable today for the Strategic Finance magazine of the IMA called Measuring and Managing Customer Profitability. And share that article, maybe these slides with your line managers, and have a discussion in a conference room about what they learned. Your success depends on how well and how fast the right information and intelligence gets to the right people. I'm not, you see the covers of my books, I'm not promoting my books. In fact, do not buy my books. But if you go to Wiley or Amazon, chapter 1 is a free download. If you read chapter 1, you'll pretty much get a good idea. There is my email address. You can send questions to, but it looks like Monty and Larry and Doug, we've got 4 minutes. So I'm not sure any questions were asked in the chat room. I can't go there. So I'll either hand it back to Larry or Monty. You're muted, Larry. There you go.
Are there any questions? I'm not seeing any chat, but if you could type some in very quickly. One question that occurred to me, Gary, as I was looking at this is to what extent does customer relationship management software has it started to improve customer profitability information at all? Does it provide an incentive to marketing departments and sales departments?
I am not aware of any CRM is the acronym for customer relationship management. You know, vendors would be like Salesforce. Well, there's just so many. And I think this is why, look at us, here we are in 2021, and the opportunity to basically start integrating some of the other commercial software vendor tools with these other vendors, I think is a great upside opportunity. Those marketing and salespeople, they deserve this information. And if they don't want to see it, well, shame on them, you know, because then they're not really thinking about how do we really improve the bottom line for the amount of money to the shareholders and the owners. They're just worrying about getting their commissions.
Yeah, one question just popped up, and I'm going to let you handle it. How can we manage inventory using activity-based costing?
Well, that would be much more operational. And also a way, which I did not put in, I didn't want to complicate the slides, is you can actually include the balance sheet with cost of capital. In other words, you can look at a driver like inventory turns for the cost of capital, because if you've got some slow moving items in inventory, of which, you know, I got piles and piles of it up to the ceiling, and I've got fast moving items with faster volume, you know, well, then I should be basically charging the inventory that's up to the ceiling with the cost of capital. Same thing with receivables, day sales outstanding. So that would be a way to get a better visibility of the cost of the inventory. So we're at 2 minutes to go. I'm thinking, Larry, can we do a wrap up? And can you maybe just share briefly a little bit more about our PACE website and our PACE LinkedIn for people to basically go to?
Yeah, we did get one more kind of interesting question, Gary, if you want to take a look at it.
No.
This questioner says they have just in time. How do you see ABC interacting with just in time?
It just basically, you can go back to lean management. You can sequence the activities in the ABC system, tag them with value added, non-value added. It's called lean accounting, you know, different types of costs for different purposes for different users, and they can do something operational. So Larry, I think we got 30 seconds. Just do a wrap up.
Yeah, and I want to thank everyone for coming. We'll be doing another Profitability Analytics Center of Excellence webinar, probably about this time next month. We will publish that on both the Profitability Analytics LinkedIn site and the Profitability Analytics Center of Excellence website. And I encourage you to take a look at that. It's profitabilityanalytics.org. And the other thing I want you to consider using, if you have any comments or questions regarding this, you're welcome to contact Gary directly, but would also love to have you use the Profitability Analytics Center of Excellence forum, and not only get Gary's input, but put your ideas and your thoughts out there for all of our you know, getting up on nearly 1,000 participants to provide some input and observations. You never know what you might learn when everybody that's interested in profitability comes together and starts thinking about it. So with that, I think we'll sign off for this week. Thank you very much, and we'll do it again next month.